right, everyone, this is Vishal from Equity Guru, and welcome to another chart attack video. Being quite a wild week, in the equity markets, currency markets, whatever you trade, a lot of headlines, and it just seems that we're back to that pivot, the Fed pivot trade once again. You can see earlier this week, actually starting on Monday, October 3rd, we had a big green day, then we've had another big green day on October 4th, which was Tuesday. And then we began to sort of fizzle out on Wednesday and Thursday. And, a lot of people now saying, oh, it's the dead cat bounce, bull trap, whatever you want to call it. But I think, again, we've talked about this in the past. There were these two sort of narratives with equity markets, fundamental narratives, right? So it was first the whole pivot, central bank pivot trade where, hey, rates are rising too much. It's slowing the economy down. Central banks are going to have to start being less aggressive, less hawkish. Hawkish is the term that you use in central bank jargon, and they'll begin to start. Well, they're not going to start cutting interest rates, but the whole idea of they might slow down and then maybe hint at cutting interest rates, right? So there is that trade, and then there was also the inflation trade, which we basically transitioned from the inflation trade to the Fed pivot trade, but we're perhaps transitioning back to the inflation trade once again. And that was the whole idea of inflation is rising, so central banks have to keep their feet on the acceleration pedal, keep hiking interest rates. So it seems earlier this week, I should probably have the article up here for you guys, but let's get that up because I think it's an important one. But it was the United Nations, which came out exactly on Monday, saying, hey, central banks, please stop increasing your interest rates, right? There's going to be this global recession, and it'll be good if you guys can, stop raising interest rates because a global recession will be bad for the world economy. But then on the other hand, central banks are sort of saying, hey, yes, we have to keep raising interest rates in order to tame inflation because it's nowhere near our 2% threshold. So this is sort of the dilemma that central bankers are in. You're getting all this pressure from the UN and I guess governments as well, the middle class, the consumers, saying, hey, interest rates are rising too much. It's getting too expensive for us to borrow money, to pay mortgages, etc. But then on the other case, the central banks are saying, hey, we have to do this because we have to raise interest rates much more than people expect in order to tame inflation. And we have to keep interest rates up higher and we have to keep them up, longer than expected, right? So a lot of people, I think, are thinking rates are going to start coming down pretty quickly, but central banks want to keep, high interest rates up for a while just to tame that inflation. So this was a whole dilemma, right? It seemed like we were back into the Fed pivot trade. A lot of people are saying, hey, the UN's saying this, so central banks are going to have to begin to pivot and be less aggressive. However, this is now where technicals can sort of step in. And we made a video, I think it was last week, on the markets talking about this breakdown levels and really saying that the weekly charts are what you really want to be watching, right? Because we do technically have a breakdown, and a lot of people are actually talking about the kiss of death pattern. Check out my article on Equity Guru about the kiss of death because it is a bit more technically inclined, but it's a pattern that's come out in 1929, 1969, 1970, 2000, 2008. And I think it's quite an important one, but it is a very long-term pattern. It's like a monthly chart pattern, so it's not really going to affect the market, say, right now. But we have basically taken out or we've rebounded from the lows that all these markets have printed for 2022. But once again, in the past videos, we've been talking about these resistance levels on the equity markets that still need to be taken out. The technical term is these lower highs. So as long as we're not, above 3,900 on the S&P 500, there's still a possibility of us declining lower. So fundamentally, keep the whole central bank, narrative, the whole inflation narrative, the pivot narrative in your mind, because I think a lot of the market is thinking central banks are going to be pivoting. And we just got this article out from the Bank of Canada today, came out on the 6th of October. Bank of Canada's hawkish message bolsters case for another large rate hike. So the Bank of Canada Governor Tiff Macklem came out saying, hey, we're not really slowing down yet because we have yet to see clear evidence that underlying inflation has come down when combined with still elevated near-term inflation expectations. The clear implications is that further interest rate increases are warranted. So, the markets are thinking that central banks are going to pivot. However, central bankers are saying not yet. So if I were you guys, don't count on the Fed pivot trade. I think too many people have been trying to predict that, trying to predict a pivot from central banks, and they've been disappointed. I would stick with the technicals. And if you guys are readers of my work or watchers of the videos here, there are two charts that we've been watching. And I might sound like a broken record, but these two charts are very important when you want to follow the markets. Number one is that bond market chart, the 10-year yield, TNX is a ticker, or you can use US 10Y. But essentially, as this goes higher, as we see yields continue to increase, it will add pressure to these stock markets. And what do you know, when yields were dropping, that's when the markets were rising. And on the days that the yields are beginning to rise, that's when we saw that market increase or that market pop sort of begin to see some sort of resistance. So keep an eye on this chart. I think we still have to break below 3.50 if I want to see a larger rebound in the equity markets. And then, of course, watch that US dollar chart, which, again, had a nice breakdown, I want to say a breakdown, sorry, excuse my language there, I meant a pullback in an uptrend, which took us to 110 on the DXY. And what do you know, on those days, that's when the markets were beginning to rebound. And on the 2 days where the dollar is strengthening, we see the markets stall once again at resistance. So keep an eye out on this 110, 109 level. If we break below that, then I think we have a longer term pullback in the dollar, which will be positive for the equity markets. So if I want to leave you with three things, watch that dollar chart, watch the 10-year yield charts. Those are the two most important charts if you want to know where equity markets are going. And then fundamentally, a lot of the market is still pricing in or pretending to, or acting on this rumor that central banks are going to be pivoting sooner because of a recession. And I just want to note to people that this could be a case where we may be in a recession. However, central banks will continue to raise interest rates within that recession. And, things are out of the textbook now, right? We've had the Bank of England wanting to raise interest rates while doing some sort of quantitative easing program while buying government bonds, right? Or gilts, 10-year gilts. So a lot of things are happening. I would just stick with the technicals. That's what I like to do. And sometimes the best thing to do is, just stay on the sidelines and wait for your technical triggers to trigger a trade, right? If you don't have that, you just wait, be patient. I know it's sometimes hard to do, especially when you have a lot of headlines saying that this is the bottom, this is the dip, central banks are pivoting, now's the time to buy into markets. Trust your strategy and your criteria, and that can get you through these confusing times. So that's it for me, folks. Give this video a like. Let me know in the comments if you think this is the actual bottom for markets, or if you think more central bank hawkish language and jargon is going to drive these markets further down. I really want to hear what you have to say, and I'll catch you guys all in the next chart attack video.